Hello, I'm George Kittah, financial strategist with Four Oaks Financial. Welcome to Market Moments with George. Please like and subscribe to get weekly notifications. Top financial headlines this week. Bill Gross's investment, tips, and more. Welcome back to our channel. Today, we're diving into the top financial headlines you need to know this week, from Bill Gross's latest predictions to the factors impacting inflation and your wallet. Let's get started. Billionaire investor Bill Gross, also known as the Bond King, recently made headlines with his recommendations for investors to brace themselves. He believes the current bull market is running out of steam and suggests a more defensive strategy going forward. Now, Gross isn't just some random guy with an opinion. This is someone who built PIMCO into a fixed income giant. So when he talks, Wall Street listens. So, what does he recommend? Well, he's a big advocate for short-term Treasury bills right now. He sees them as a safe haven while also offering a decent return in this rising interest rate environment. On top of that, he's also keen on investing in undervalued emerging markets. He believes they have the potential for some serious growth, especially as developed markets start to slow down. All right, let's talk about long-term Treasury yields, which have been on the rise lately, and the impact this has on your money. You see, when yields go up, it usually means investors are getting a little nervous about the future and are looking for safer places to park their cash. And what's safer than US government bonds, right? Well, this can affect everything from mortgage rates to the cost of borrowing for businesses. To make matters even more interesting, we've got the upcoming elections adding fuel to the fire. With all the uncertainty surrounding the elections, investors are getting even more cautious, and that's putting upward pressure on those yields. The Fed is stuck between a rock and a hard place, trying to balance inflation with keeping the economy stable. Unpacking the core CPI, used cars, sticky services, and gasoline. Now, let's break down a crucial inflation indicator, the core CPI, which strips out volatile food and energy prices to give us a clearer picture of underlying inflation trends. Recently, we've seen core CPI accelerate for 3 consecutive months, and there are a couple of big reasons why. First, used car prices, which had been a major driver of inflation, have surprisingly flipped and started to decline. This is partly due to easing supply chain issues and shifting consumer demand. However, don't celebrate just yet. We're seeing stubborn inflation in the services sector, things like haircuts, dining out, and healthcare. These prices tend to be sticky and don't come down easily. And then there's gasoline, which saw a significant drop in prices. While this is good news for consumers at the pump, remember that energy prices can be volatile, and this relief might be short-lived. U.S. consumer sentiment dives. The high cost of living bites. Consumer sentiment took an unexpected dip recently, and it's no surprise why. The high cost of living is weighing heavily on Americans. From groceries to housing, it feels like everything is more expensive, and that's putting a damper on how people feel about the economy. When people feel less confident about the economy, they tend to cut back on spending, and that can have a ripple effect on businesses and overall economic growth. It's a classic case of economic psychology at play. If people are worried about their finances, they're less likely to make big purchases, invest in the stock market, or even go out to eat as often. This drop in consumer sentiment is a clear signal that people are feeling the pinch and are adjusting their behavior accordingly. Stay informed and invested. That's it for this week's top financial headlines. Don't forget to like, subscribe, and hit the notification bell for more updates. See you next time. And now, here's a quick summary of what we covered today. Bill Gross, the Bond King, is advising investors to get defensive with short-term treasuries and emerging markets. We also discussed the rise of long-term Treasury yields, fueled by election jitters and the Fed's balancing act. Take control of your financial future. Contact me today.